This is The Close right here from Studio 2 in New York. I'm Romaine Bostick.
And I'm Alex Steele. We are denting that rally that we've seen over the last couple of days. Is that buy the dip going to come into play?
Yeah.
We'll dissect that throughout the next couple hours. So look at the S&P. We are now flat. It looked like we were going to be for 3 straight days of gains, which we haven't seen since early February, but we can't really seem to get that momentum within the equity market. The VIX, though, is still relatively calm. You are seeing a little bit of a bid in the bond market after a very solid 2-year auction, and copper futures remain at a record high. So there's some wait and see, some pause, and there's some risk taking, and then there's some safe haven buying. So take that for what it's worth.
Yeah, it was kind of interesting the way this market opened. It basically kind of opened flat and has gone nowhere since. And yesterday I really posed this question as to whether the worst was really behind this market. And I think we're getting a clearer answer today, given the slide lower that we are seeing in equity prices. And don't forget that nudge higher in bond prices, Alex. Trade risk and the economic risk, those are the two elephants in the room, which means those back and forth trading sessions, up one day, down the next, flat the next day, and who knows what after that. Those swings likely not to end anytime soon.
Well, we're in for some turbulence here. I think we've seen that in the financial markets. We've seen that in some of the soft data. We're going to see that a little bit in the hard data. But again, we do not have, to be clear, we do not have recession as a baseline.
And that last point is key here. Recession risk is by no means being priced into this market. But economic malaise, well, that certainly is. And why? Well, fresh data showing a gauge of consumer confidence, well, that was decreasing last month to the lowest level since at least 2021. And then you had a measure of economic expectations for the next 6 months. That's dropping to the lowest level since 2013. Survey data, to be sure. Yes, that is the asterisk. It's how people feel. But when does that actually translate into how people behave? We're going to get a taste of that on Friday with the release of personal spending and income metrics. And maybe we got a taste of that this morning with the government's report on new home sales. While sales did rise, below expectations, I should add, so too did the supply of new homes, rising to the highest level since 2007. Maybe, Alex, that's a reflection of some of the burgeoning differences we're starting to see in this economy.
Yeah, we'll have to see if it filters through even more. KB Home not feeling really good about the outlook there for housing. So this brings us back to that point about stagflation, right? If you have higher inflation and lower growth, how do you play that? Bank of America yesterday was talking about quality. This is another way to look at it. So the white line is the Goldman Sachs long-short stagflation basket. So on the long side, you have things like commodities, oil and gas, gold, industrial metals. On the short side, you have some consumer discretionary, semis, hardware, consumer finance names. Then you compare that with an S&P on a normalized basis going back since the beginning of this year. And you can see just how that stagflation basket over the last month has really started to outperform. Does that continue? Or have we reached this peak uncertainty? And from here, it's only going to be better?
Okay, I don't know, Alex, but taking a look at that chart, it really kind of gives you a sense here of where investors' heads have been at. Julian Emanuel joins us around the desk right now. He's the chief equity and quantitative strategist with Evercore ISI, kicking us off to the close. And I do want to start with that chart that Alex had up, because I don't know if I was looking at a defensive play, a hedge, or what that was, but it's very clear that you do have a large number of investors who have decided that there is some sort of economic condition that they should be guarded against.
Yeah, no question about it. And in a lot of ways, the market has been trading the stagflation theme these last couple of months. We came into the year recommending that you wanted to actually be long the volatility factor. So on a quantitative point of view, we wanted to be long the low volatility stocks and short the high volatility stocks. And frankly, that did very, very well. So well that actually at the trough a couple of weeks ago, it had outperformed by about 20%. And our data showed that if you kept outperforming, that would indicate you were at the start of a bear market as opposed to the end of a correction, which we feel you're at. And frankly, if you're trying to play the stagflation theme, long consumer staples, long healthcare, that horse already left the barn, and we think it's time to take a fresh approach.
And just for, this is when I kind of explain things to my mother who watches Joe. So stagflation, we're basically talking about slowing growth, but potentially higher inflation. Is that the general idea?
And just, for ease of numbers, we call that anywhere between 0 and 1.5% on GDP and 3% or higher inflation.
Is that, forgive me, this is going to be a really dumb question, but is that necessarily bad? Because if we still have growth and we're avoiding recession, or at least avoiding a significant slowdown in growth, can we not tolerate slightly higher inflation from where we're at right now?
Well, in other times, there's an argument to be made that we can, but to the point that you raised at the top of the hour, is that the soft data, the opinion, the sentiment has had enough of a dent to whereby if you had the perception that particularly the inflation piece had further to run, that's where you can change the sentiment and have it actually infect the hard data. We haven't seen that yet. And we still think that the labor market, particularly on the private side, is relatively strong. The next payroll number is going to be lower than the last one, but nowhere near indicating anything close to a contraction.
I should point out, though, that consumer conference data did start to talk about the labor market and worries about wages for consumers and for individuals. So maybe there's a little bit on the margin that we're changing. So wait, are we at peak uncertainty? The whole one step forward, 5 steps back that you talk about a lot in your must-read notes. Are we done with that?
So look, we're going to hear something on April 2nd. It's the only thing you all are talking about.
Yep.
It's the only thing our clients want to talk about. And by virtue of the fact that everyone is obsessed with what we are or not going to hear on April 2nd, whether there's a sledgehammer or an off-ramp, or what we think more likely a combination of the two, tilting towards the off-ramp, you are going to get what we think will be peak uncertainty, right? So
we haven't seen it yet. We'll get it.
Well, we are more or less at it.
But I mean, just on that point, though, so you think that April 2nd will be somewhat definitive in terms of where policy is, where it's going? Because it seems like a lot of the market ructions over the last few weeks has had to do with the fact that nobody seems to know. We get one announcement in the morning, and then by the end of the day, he posts something else on social media that almost contradicts that.
No, it won't be definitive in that respect, but I think we'll get a good feel for the tone. And if you go back to last week when Trade Representative Greer suggested that there was more likely an off-ramp, and then, of course, Bloomberg reported over the weekend that it might be a little toned down. And then the comments we just saw about Canada and Mexico are starting to play ball. All of that would lead us to believe that there are more months of negotiations to come. But the beginning of the process of the uncertainty resolution on the part of corporates who've really had difficulty in planning, and ultimately our view is what's going to lead to the capital market cycle that everyone is expecting, that is going to happen.
At the same time, though, the TINA world, there is no alternative, seems to not be there anymore. There are alternatives now, even if some of that uncertainty is resolved, no?
And you know what? It's a good thing. It really is a good thing because, frankly, you get to a point where there is a discomfort around concentration risk. There is a discomfort around earnings concentration risk. And in the U.S., you're going to have earnings broaden out this year. And in terms of the rest of the world, an argument can be made that after 12 years, the rest of the world is going to join the party. And what we've seen going back in history, that even if there is a multi-quarter or multi-year outperformance to the rest of the world, the U.S. boat can float as well.
Okay, because that's what I'm saying. So maybe some of that money that's pouring into Europe, and maybe whatever the end result of that is, that won't necessarily be at the expense of U.S. performance.
It feels as if it has been in recent weeks. The flow data say that it has been. But in terms of the price action and the impact and the re-engagement of the retail investor in this country, who would be very much engaged if there was a little bit more confidence, it doesn't have to be a zero-sum game in the least.
So where in the U.S., if you wanted to play this thesis, do you like right now?
So our view is if you think about what ends bull markets, at the end of any bull market, sometime down the road, you have that speculative phase, you have that capital markets phase, and typically what happens is the bull market leaders tend to lead the charge at the late cycle. And from our point of view, if you look at it's beyond just the Mag 7. One of the Mag 7 we know has had exogenous political type factors associated with it. But a lot of these names have just gone sideways for months on end. And frankly, when you think about how and when and why stocks and markets correct, sideways within a very strong uptrend usually resolves itself higher, and we think that's the story.
All right. Well, always illuminating to talk to you, Julian, and great notes every time we get them in our inbox. Julian Emanuel, he's Chief Equity and Quant Strategist at Evercore ISI, kicking us off to the close here on this Tuesday afternoon. A lot to get to, including a closer look at the oil industry with one of its biggest players, the CEO of Shell, Wael Sawan, going to be joining us on the heels of the company's Investor Day presentation.
Plus, a conversation on litigation finance, why the business is booming and what areas are seeing the most active targets with Chris Bogart, CEO and founder of Burford Capital.
And from boom in litigation finance to the potential boom in M&A, a conversation on when the iced over IPO market could thaw out. Eric Liu, partner, co-head of private capital over at EQT. He'll be joining us a little bit later right here on The Close. This is Bloomberg.
Shell shares here in the U.S. are up by about 1% after the company's Capital Markets Day at the New York Stock Exchange. One highlight, plans to become the world's top LNG trader, saying it's going to expand sales by 4 to 5% a year until 2030. The British energy giant also vowing to increase shareholder returns and cut spending. Joining us to discuss this further is Wael Sawan, Shell CEO, joining us from the floor of the New York Stock Exchange. Wael, really great to see you. Thank you so much for joining us. Congrats on getting through the day. Huge LNG targets, in particular of how much it's going to make up in terms of your business, 20-30% larger by 2030. How do you get there?
Yeah, thanks, Alex. Look, we're very proud of where we are today. Today in the Capital Markets Day, we took a pause and reflected on the journey we've been on over the past couple of years. And the key message was one of trying to instill confidence. Here's a company that has delivered what it said it was going to do and actually over-delivered in certain areas. And beyond that, as you rightly pointed out, we've also today laid out a vision out to 2035 that has LNG at the heart of it. Mm-hmm. We believe LNG is going to be a critical part of the energy system, and we want to be the leading player in LNG. But our story also has lots of richness around wanting to sustain material liquids production and being the most competitive and the most focused energy marketer and energy trader in the world. And so a holistic story that I think we're very proud to be able to say is well on track.
Are you worried at all about a potential looming LNG supply glut and kind of betting really big on this for the next 10 years at a time where there's just too much supply coming online?
Look, in my job, I have to look at 20 years. And what I see when I do that is up to 2040, we see a potential 60% increase in overall LNG demand. We have a diversified portfolio, both of production sources as well as demand options. And we are very much looking to leverage that global diversity of production and customer contracts to be able to create value. Importantly, our LNG portfolio is heavily linked to long-term contracts that are tied to Brent, which means we have a lot of resilience. And so we can ride out the inevitable cycles in this business while making sure that the underlying cash flow continues to come from this business.
So what should investors look for in terms of the capacity increase on your LNG output?
Very much what we outlined today, which is 4 to 5% per year. So indeed, the 20 to 30% by 2030, and that's just to 2030. We see more running room beyond that. We have projects that we can evolve over and above that. But what's unique around our LNG business is not just the production piece. We are actually also selling roughly the equivalent amount, not just of what we produce, but also another equivalent amount to that, because we're also one of the largest optimizers of LNG in the market. And so in any year, we're selling around 60 million tons of LNG, which is significant. And so we are trying to continue to build up our portfolio to really have that diversity and to be able to make sure that we can continue to essentially stay in the 15 to 20% of the overall LNG market is what we represent.
So once you get to 2030, Wael, what actually happens to the oil side of this business?
So we have a very clear pathway to sustain our liquids production to the tune of around 1.4 million barrels per day between now and 2030. And we have plans to extend that plateau well into the future. So we already have plans in place for that. And so the key areas where we see growth at the moment are our integrated gas business, as we've talked about, LNG, but also I would say our marketing business, our mobility business, which is the leading franchise in the world, our lubricants business, which is another core part of our overall value proposition. So those will be growth trajectories. And our sustained liquid production will allow us to have the fundamental underpinning that continues to keep us as a scale company overall.
Sustained liquids doesn't sound like growing oil production. And you know this is my way of asking about you guys don't have Permian assets.
So what we have is a very diverse portfolio. We have the largest position in the Gulf of America. We have the largest position in Brazil, which are the two premier deep water basins in the world. Right? It requires a lot of running just to stay flat. So these portfolios are declining at anywhere between 4 to 6% per year. So one has to stay running fast just to stay flat. Beyond that, we will look at opportunities, and we will continue to look at those opportunities. But of course, we've left the Permian, and we believe that the opportunities we have in front of us in the Gulf of America, in Brazil, in many of our heartlands like Kazakhstan, Oman, Malaysia, those are the places where we want to continue to strengthen our portfolio.
The analyst notes about today were all relatively positive. RBC said a really nice quote, said, "Today reads as more evolution than revolution." And I'm wondering if the revolution part is what investors need to see to have Shell shares start to outperform the likes of Exxon as well as Chevron. And would that evolution be buying a U.S. gas producer, doing some sort of substantial oil deal?
I think there's a couple of dimensions to that question. I'm very pleased with the evolutionary nature of it, and it's important that one footnote in all that discussion is that we have bought back around 20+% of our share register over the last 3 years. And a big part of what we announced today is we will continue to preferentially lean towards buybacks, having indeed increased the overall distributions to 40 to 50% of our CFFO. On this trajectory that we're on, we will have quietly bought another 40% of the company by 2030. To me, the revolution is not in singular actions. It's in looking at the life cycle over a period of 7-8 years. If we can buy more than half of this company, that is what is truly going to be differentiated and transformational for our shareholders.
So, while I do want to ask you, though, about just the general structure. I mean, a lot of in terms of the cash giving back, there has been a lot of discussion in analyst circles about this idea of why we haven't seen more balance between the dividend versus the buybacks relative to some of your competitors.
Yeah, it's a great question. I think the first thing I keep getting asked is, can you grow your overall share of distributions? And thankfully, we've been able to move from 20 to 30 to 30 to 40 to 40 to 50. So big tick there. Then indeed, it's the balance of how we want to return capital. It's a point that you both made earlier, which is we still find that our fundamental valuation does not fully price the cash flows we see into the future. So what a great opportunity to be able to use every marginal dollar of distributions to be able to buy back our shares and create that life cycle value for our shareholders. By the way, we have increased our dividend per share by 25% over the last 2 years, and we have a 4% progressive policy around our dividends. So we are addressing the dividend. But today, the right capital allocation option is to go into more buybacks, and that's what you see us doing.
Investors also, Wael, have also, I guess, pondered, if not asked the question, about your listing. Obviously, your primary listing overseas. You're standing there on the floor of the New York Stock Exchange. Has there been any sort of meaningful discussion, thought, consideration about making the U.S. your primary place of listing?
There has been, and indeed we made the decision a couple of years ago to move our listing our headquarters over to the UK. At the heart of it, our focus is to make sure that we are driving the fundamentals up. To me, that means growing the free cash flow of the company. Yes, listing might add different liquidity, but we're already very liquid here in the US. Over 50% of our shareholder base is a US shareholder base. So we are attracting many of the investors that believe in the investment thesis we have. And so while we focus today on making sure that we're pulling every lever to build consistency, to build resilience, and to build longevity, of course, we keep all options open. Right now, a change of listing is not a live discussion, but it's always under review, and of course we'll look at it when the time is right.
It feels like a no for now, Wael. I'm just going to paraphrase that. Going back to M&A for a moment, you're going to love this question. But when it comes to, say, BP, I know you get a lot of questions on when, if, how are you going to buy BP. But I want to approach it from another angle and talk about synergies. A big part of your outperformance in the past couple of years has been synergies and weeding out those costs. At what point does BP become so cheap you just cannot avoid looking at them for those synergies?
Alex, you'll forgive me if I don't directly answer that question, but what I will say is our focus over the last 2 years has been to build fitness and strength for Shell. Right? Today, people are asking the question because they see a fitter, stronger, more dynamic company, and that to me is great. We want to be able to build flexibility. We've been able to bring our net debt down to essentially the lowest it has been, excluding leases, for over a decade. We've been able to outperform our peers in the sector on both TSR as well as just pure share performance. And we are generating free cash flow in a very robust and solid way. And so today we have options. At the same time, when we think about those options, the priority is to deliver that 10% free cash flow per annum growth within our business. That's immediately within our control. And of course, we will keep an eye out for opportunities, but I have to say the bar is high. Because if you're going to go for a big acquisition, one has to recognize that that can potentially distract, and therefore we're very focused on making sure if we do something in the inorganic space, that the bar is high and that we go in ready to do that.
That also kind of felt like a no. I'm just saying, from where I sit. Yeah.
I would qualify it, Alex, as it's finding the right time to make the moves in what is a long journey for us.
Okay, but is BP like on the road to the moves, or is BP like on the highway somewhere that you're not passing?
What I would say is we are always looking at companies both in Europe and beyond, and every company will have its time, and at that point we'll make a decision.
All right, well, I'll get you off the hook here and give Alex a break for a second. I do want to get your thoughts, though, on just broader economic conditions globally. And I have to ask you, of course, about what's going on here in the U.S. politically. And I know you don't have a lot of exposure to assets here, but obviously what we do here has ripple effects across the world. Have you actually had a chance to actually meet with anyone from the administration, including the president? So firstly, just a correction. So our biggest capital employed globally is here in the U.S. We are the largest producer and operator in the Gulf of America. We are the largest off-taker of U.S. LNG of any company. So we have a very material presence, not to mention 13,000 staff that are very much the core of our company here. I have had the opportunity over recent weeks to indeed meet many in the administration, including the privilege to meet the president. And what I would say is we are very encouraged and welcome the strong support for the energy sector, not something that has always been there in the US or beyond. And I do think the energy sector is a critical underpinning of any successful economy. Beyond that, what I would say is what is key for our sector, for companies like ours, is predictability in the investment climate and the stability of the investment climate, because many of our investments have payback periods usually above 7-8 years.
Yeah.
And so that is a critical part of being able to have the peace of mind to make the material investments that we need to be making.
Well, before we let you go, if there is a peace deal between Ukraine and Russia, are you anticipating Russian gas flows to Europe, and how are you seeing the global flows here?
Difficult to call where that ends up playing. I mean, what you find, of course, is Russian gas to Europe has gone down from roughly 40% of Europe's demand to just under 10%. So potentially some flows will occur. What we are focused on is making sure that through our world-leading trading capability that we have, that we are managing all these potential discontinuities that we are seeing in trade flows. And so we want to make sure that we can deliver to our customers. How the situation in Russia evolves is anyone's guess, but we are preparing for multiple different scenarios so that we can honor those trade flows that need to be met.
Wael, we really appreciate you taking time for us. I know it's been a long and busy day. Wael Sawan there, he's the CEO of Shell down there in downtown Manhattan on the floor of the New York Stock Exchange. Alex?
Yes.
Yes.
Yes, he's not. I mean, no BP headlines. I was really hoping that was going to happen. I did. I tried many different forms.
I thought you were going to slide out of your chair for 1 second.
I really wanted something. I really wanted some news. But you know what's interesting?
Yeah.
They are the first LNG exporters that can export LNG from Canada on the West Coast.
Oh, really?
Yeah. Phase 1. Yeah, that's a big deal for Canada.
All right.
Will it be phase 2? Is this a whole new era?
All right, something we're keeping an eye on
Maybe with
here.
BP?
We're going to make a hard pivot when we come back after the break. A conversation now about energy, a conversation up ahead about litigation finance. It may sound boring, but it's one of the hottest corners of the finance world. Christopher Bogart going to be joining us after the break. .30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We are fading as we get closer and closer to the close. Yes, the Nasdaq is still up 0.2%, but we are rolling over.
Yeah, there's no conviction. We talked yesterday about how much conviction there was in the rally, and there was on
you
the
were
daily
into it,
base.
man. You were into it.
I admit. But just don't play yesterday's tapes. Today's a new day. But it gets interesting because we kind of opened the market. Everything was pretty much flat, and it's kind of the same thing we've been talking about for the last few weeks: tariff risk and economic risk. And we got a taste of both today, particularly on the economic risk.
Yep, particularly when the confidence came in, and I mentioned it earlier today too, is that you wound up having people concerned about their jobs and their wages. That's a little different than being concerned about egg prices. So we'll see if that again filters through, but you got to see it in the hard data.
Yeah, and we've talked a lot here about when that hard data is going to start. We've seen some of it bubbling up in some of the data, not just in the survey data. We get a big report on Friday with the personal income
Looking forward to
spending
that.
and stuff. It'll be interesting to see there. Are you going to be here that day?
I'm going to be here that day, but how are you going to pivot right now? What's your pivot?
I don't know. I was trying for a pending.
Finance.
This is a hard pivot because what Alex is alluding to here is we actually got a great guest coming up right now. And it's a somewhat arcane topic for a lot of folks. It's called litigation finance. And in a nutshell, it's where investment companies pool capital to fund or even just to simply profit from other companies' legal actions. And it has boomed. Whether it's bankrolling class action lawsuits to taking stakes in patent disputes to helping companies negotiate with creditors. There was a Bloomberg Law survey last year that found antitrust and commercial litigation were the most active targets in that space. As for this year, our next guest, who runs one of the few publicly traded litigation funders, actually sees growing opportunity in bankruptcy and restructuring cases as corporate defaults, as we reported on this program, are anticipated to rise. Chris Bogart joins us right now around the table. He's the CEO and founder over at Burford Capital. Chris, great to have you here.
Thanks very much.
Let's start a talk about just broader economic trends, particularly when it comes to corporations. We've had a lot of folks on this program who've said they anticipate to see somewhat of an uptick in not necessarily bankruptcy filings overall, but certainly in corporate restructurings and corporate distress, if you will, is maybe a more umbrella term to use it. Kind of explain how a company like yours even gets involved in that and why.
Well, you're absolutely seeing that trend come to life right now. Numbers are up all across the board. And so what you have often in bankruptcies is a world where you've got no money left, but a pool of viable claims. And the question then is, how do you pursue those claims? And the answer is that creditors don't want to put good money after bad and put more money into the bankrupt estate for some potentially long duration outcome. And we do that instead. So we come in, we're appointed by the courts or by liquidators or by receivers, and we put capital in against the value of those claims to enable them to be brought so that creditors can ultimately get a higher return.
What's the sort of balance, though, in determining whether you're actually going to make your money back and, more importantly, profit off of that? Because there's a lot of uncertainty that goes through these proceedings, which can drag on, in some cases, for years.
Yeah, there's absolutely uncertainty in litigation generally. I don't think there's any more uncertainty in bankruptcy litigation than there is in any other kind of litigation. We've got a 93% success rate, and that speaks to how much time and energy we put into looking for meritorious, high-value lawsuits.
How do you find what a good bankruptcy investment is? I don't even know if that's the right term.
Yeah, well, we're generally brought in by the lawyers or by the other people involved in insolvency and bankruptcy to be a participant in the process. The dynamic is one that is very common. As I said before, it's a world where there are claims, but no money to pursue those claims. And sometimes what you're after is just money to pay the legal fees, which, as you know, have been growing rapidly. And sometimes you're actually trying to get money into the estate immediately to distribute to creditors, and we'll put that money in against the future value of the case.
Why is your area so hot right now?
Well, litigation finance is a wholly uncorrelated asset class. And I think in times of economic uncertainty, economic turbulence, that's very valuable. All of our cash flows come entirely out of the outcome of litigation results. And those are independent of what's happening in the markets, independent of what's happening in the broader economy. And as a result, the other dynamic here is that companies, and moving away from insolvency a little bit, companies are paying too much in legal fees, and they don't like it. It's collateral to their businesses, it's reducing their profitability, and it's not doing anything that advances their core undertaking. And they don't like that. And so we take that away from them. We pay the legal fees on their behalf.
Yeah.
We sometimes attach the value, and that's really valuable to them.
That's certainly the positive. I'm sure you're well aware this is also not without controversy. There was a GAO report a couple years ago that said exactly what you just said as far as the benefits. They also raised some concerns here about whether this just draws out litigation, whether it's too costly for the litigants themselves, the ones that you're basically representing. And I am curious as to where the balance ends up.
Well, I think the balance, when you look at somebody like us, we're a multi-billion-dollar publicly traded New York Stock Exchange company. Mm-hmm. Just like any other investment or financial firm, we're looking for high-quality assets that are going to produce a reasonable return in a short period of time. Mm-hmm. So we're absolutely not in the business of being interested in prolonging duration or in bringing forward things that are not ultimately going to yield a good result for our shareholders. Mm-hmm. So I think those are false concepts.
How are you finding clients, if you will? Are you seeking them out? Do they come knocking on your door? How does that work?
I think it's both. Mm-hmm. There's a strong demand, as you said in the intro, this is booming. There's a strong demand for these services, and it comes back to that fundamental point. If you're the CFO or the CEO of a big company, you're spending too much money today on legal fees. Legal fees, there are lawyers out there now who are charging $3,000 an hour. That's a lot of money. Mm-hmm. And none of that is helping your shareholders. It's all collateral to what you're doing. In fact, it's diverting operating capital from what you should be using for your shareholders. And so the ability to offload that to somebody like us is very valuable. It's a little bit like leasing for litigation.
Who are your investors? Like, how do you get the pools of capital? How do you source that?
So we're a permanent capital vehicle. We're publicly traded on the New York Stock Exchange and the London Stock Exchange. So our capital base is the equity that we've raised, the retained earnings that we've generated, plus a moderate level of leverage.
And what is the feedback that you wind up getting, say, from investors? Like, how much more do they want? How big do they think that this area could grow?
Well, if you think about law in general, like legal fees, that's $1 trillion a year global market. Litigation judgments, that's a multi-trillion-dollar a year global market. We're really happy because we've grown from a little business to a pretty big business now, which means we're doing maybe $1 billion a year of that business, $1 billion over $3+ trillion. There's a lot of room to run here.
I also just, too, before we run out of time, I mean, obviously your business is much broader than just bankruptcy litigation. Probably one of your more famous cases, your involvement in that national driller in Argentina. I don't know if that's been resolved, but there was political risk in what you do as well. Because, I mean, you might win a case, but if you're in a country that maybe the rule of law isn't quite the same maybe as here, you're not necessarily guaranteed to get your money.
Look, there's all sorts of risk associated with what we do, which is why, as you said earlier, the pricing is reasonably high, which generates high returns. The Argentina case you're talking about is a classic example, in fact, of the bankruptcy problem. The holder of the equity shares in YPF, the Argentinian driller, the holder of the equity shares in Spain went bankrupt because of bad acts by the Argentinian government. That bankruptcy appointed us to take the case forward.
All right, well, look, it was really great to get your perspective. I feel like I learned a lot. Thank you for introducing me to litigation finance. Christopher Bogart, CEO and founder of Burford Capital. Do you know that I used to work at a law firm?
Yes, I actually did know that.
Like a million years ago.
I did know that.
I think I was billed like $80 an hour for page checking. Do you know what page checking is?
You never got
like
to the $3,000 an hour
ream of
level.
documents, and you take like an eraser and you just page check all the pages.
Wonderful.
Yeah, I know.
Sounds like
it was a really
life.
important skill set.
And now look at you now.
The things you learn. All right, coming up, Cassava shares, they are down 34%. The drug developer announcing it's going to stop its Alzheimer program. We're going to break that down in today's Stock of the Hour. Up next, this is The Close on Bloomberg. Shares Shares of Cassava Sciences are plunging 34% after the drug developer said it's going to discontinue its Alzheimer's program. Now, back in November, Cassava clocked its largest single-day drop on record after its trial for the drug couldn't show significant reduction in cognitive decline in patients with mild to moderate Alzheimer's. Joining us now to discuss is Bloomberg's Jess Menton. Walk us through what we know. These guys live and die by these trials.
That's right, and especially when you have so much volatility in a space like this. So actually, when it comes to this company, they had already warned toward the end of last year what was happening in some of these trials, but there was some controversy because there was a medical professor that was tied to some of the earlier trials that was ended up being in trouble for fraud, but the company was talking about how they weren't expected, like he wasn't associated with the later stage trial. So what you're seeing here today, and especially this morning in pre-market trading, was halted briefly, but now that stock down about 34% on pace for its worst day since November 25th. So basically the drug failed to significantly reduce cognitive decline in patients with mild to moderate Alzheimer's disease.
This gets to a broader question, though, also just about these biotech stocks,
Yes.
particularly these new ones, right? Because it's basically you're betting on one drug essentially coming to market, and if it doesn't come to market, there's really no value left in the stock. Is there anything else here that they can do? Have they articulated that, okay, yeah, we failed trying to apply this chemical to this particular disease, but maybe there's another use case?
They actually brought up about how they might be able to use this for epilepsy type cases. So that was potentially some hope there. But then when you have a stock like this, especially if its market cap already below $1 billion, its stock trading below $2, so the lowest level since probably the height of what we saw in COVID, you start to get concerned about how much cash does this company have on hand. And so some of the data showed, but this would be through the end of this past year, so it wouldn't encompass obviously the losses we saw in the first quarter so far, but around $128 million in cash and cash equivalents as of the end of December.
I mean, it has lost like almost all of its market cap. Like, I mean, I did the math literally.
I just want to say, she's really
Right, she's like
doing the
pulling it out right now.
That
That's
can't
good
be
there.
true.
Wow.
I feel like my daughter. But not today, but if you take a look at the chart from like November to now, I mean.
Even pulling it back further, if you look at where its last high was, so at a closing basis, it would have been in September of 2000, trading around $161. It's down almost a drawdown of 100% in that span and trading below $2 right now.
And has this had any broader effect on biotech stocks today?
You are. So Upstream Bio. So UPB is the ticker symbol on this. That's down over 2%. Also, Maze Therapeutics is another one that would be considered a rival. MAZ is a ticker symbol on that, also down about 4%. So you are seeing it broader out. And then Sage Therapeutics, SAGE, is another one, and that's also lower.
To that point, what happens to these kind of companies? Do they get bought at the end of the day when the market cap goes low enough, or do they just like go out of business?
Well, especially in the biotech space, because a lot of those things, and especially these trials are all over the place, but when you see how much it's declined, I'm sure there's other companies that might be looking at that. Maybe if they're developing, trying to figure out something related to epilepsy, that could be something coming up. But also the A&R function, if you're looking at what sell side is doing right now for Sage right now, especially looking at that, I mean, there's only 2 buys, 15 holds, 1 sell. So obviously, there's still some controversy there on the sell side community.
All right, Jess Menton there. A closer look here at biotech stocks and the big drop in Cassava Sciences here, which was trying to develop a new Alzheimer's treatment. And it's kind of interesting. I'm glad you brought up kind of what happens to them, because it gets to this broader issue as to, when you sort of have all your sort of, what do you call eggs in one basket, is that the euphemism here, and it doesn't work out, then what do you have left?
But isn't it what these biotechs do? They literally
That's
do
what they
that
do.
in order to have a success, and then that's your one-hit wonder, and kind of that's it.
And that is the risk here. Meanwhile, we go back to the broader market as we continue to count you down to those closing bells. Jimmy Chang is up next. This is Bloomberg.
We're going to hear something on April 2nd. It's the only thing you all are talking about.
Yep.
It's the only thing our clients want to talk about. And by virtue of the fact that everyone is obsessed with what we are or not going to hear on April 2nd, whether there's a sledgehammer or an off-ramp, or what we think more likely a combination of the two, tilting towards the off-ramp, you are going to get what we think will be peak uncertainty.
Julian Emanuel over at Evercore ISI, kicking us off to the close just 50 minutes ago. A relatively optimistic Julian Emanuel, we should point out, too, seems to think that once we get to Liberation Day, Alex, April 2nd, that the market will have a bit more clarity.
or that all the uncertainty has already been sort of dissected and maybe priced. So maybe we won't have that moment where everything unravels, that then you can start to build up positions. But if not, I mean, then do you wind up getting to say his bear case for the year?
Yeah,
you know?
or maybe it's not a bear case or bull case. Maybe it is kind of, we was talking about economic stagflation, but maybe there's also financial market stagflation as well. And you're kind of seeing that today with this market pinned, at least the S&P there, right around that 57.75 level here. Not really going anywhere.
But we're up now. It counts.
Okay, it counts.
So now it's 3 straight days in a row with potential gains. We haven't seen that since early February. So there you go. I'll be the positive person today.
Well, okay, that's fine. I have no response to that. We should point out we are seeing a modest bid to bonds. That's pushing yields slightly lower. The VIX lower here on the day. The dollar not doing a whole lot of anything. In fact, that's really being constrained right now by tariff policy. Jimmy Chang joins us right now around the desk. He's Chief Investment Officer at Rockefeller Global Family Office. Jimmy, great to see you here. I'm not sure if April 2nd is going to give us complete clarity here, but I do want to ask you a broader question about Washington policies and how it's affected the psyche of markets. Is it because the markets don't like what they're hearing, or is it because they don't have that clarity or that proverbial certainty that we always like to say that investors want?
I would say it's both. If you look back to the post-election reaction, initially it was very euphoric. So market focused on what can go right. But then all along we were saying there are some policies that will create some potentially short-term pain, and now we're getting it. And add to it, negotiations are still ongoing. So I don't even think the White House knows what will exactly happen on April 2nd. It's almost like we're making it up as we go along.
Well, then how do investors react? I mean, I know when we talk about these day-to-day moves, we're primarily talking about tactical traders, short-term traders. But for a long-term investor, how do you approach this? Because it's easy to say, oh, this is just a short-term thing, and we're looking 10 years down the road. But some of the changes that this administration is making, or at least is trying to make, are long-term structural changes.
Indeed, I think massive long-term changes to the global trade, currency, finance framework. As long-term investors, we will look past April 2nd, but we'll also anticipate from a calendar standpoint, midterm election in 2026 is important to this administration. So I don't think it will want to create so much pain that it will linger into 2026. So hopefully there is a short period, let's say several quarters here in early 2025, where you go through that transition, and then you look at re-acceleration coming into 2026, going into the midterm election.
So under that scenario, let's just say that plays out. What looks interesting? Is it still U.S. stocks, or is it going to be elsewhere? I feel like Tina, there is no alternative, is now kind of thrown by the wayside a little bit.
Yeah, I think we've moved from this unipolar world where you just focus on U.S. large cap to a multipolar world where there are multiple investment themes out there. Some of them still need to be proven. For example, you look at Europe. If you look at the announced stimulus in Germany, that 500 billion euro infrastructure spending, relative to the size of its GDP at $4.3 trillion, that's bigger than the combination of our Infrastructure Investment and Jobs Act and Inflation Reduction Act. So it looks really big. So naturally, money will gravitate there. But again, we don't know what the multipliers are and how quickly that money will get rolled out. So at this stage, it's all about revaluing the market rather than upgrading the earnings prospects.
So what does that mean? Does that mean sit on the sidelines for Europe yet and stay in U.S., or does that mean yes to Europe? But
I think yes, you need to start to look at these opportunities. I think we're still early in this reallocation because for more than 10 years and probably 15 years, U.S. has been outperforming. And this is not just internal money flow domestically, but also foreign capital has been coming into the U.S. If you talk to foreign investors, I think there's a recognition that U.S. now having higher level of risk, probably some potential currency issue because the administration seems to favor a weaker dollar policy. In a weaker dollar environment, international stocks tend to outperform. So I can suspect that we're at this early stage of reallocation. People are starting to look at international as an alternative.
Yeah, and it's not just Europe. We've also seen a lot of money flowing into Asia, particularly back into China, whether it's mainland stocks or Hong Kong. But there was an interesting note today. We saw a big drop in Chinese stocks after Joe Tsai, who's the chairman of Alibaba, kind of had some interesting comments about this data center build out and how, in his words, it might be a little bit overdone, maybe a lot of overlap that needs to be reined in here. When you look at the AI trade and the general tech trade around it, whether it's in China or even here in the U.S., do you find value in it?
I do think in the long run, I actually welcome a more disciplined capital spending environment for AI. The risk right now is this overspending. And I do suspect if you look at some of the companies that one of the leading companies having spent so much that the stock has underperformed. Shall this company scale back capital spending and return more cash to shareholders? I actually think the stock will outperform. Yeah. So as a long-term investor, I'd like to see more discipline.
Well, and our big take on the Bloomberg terminal, this big story we do every day, it actually focuses on Alphabet, Google specifically, and its traditional search and this transition that they're trying to make to a more sort of, AI-based type of search, ChatGPT or whatever you want to call it here, and some of the stumbles that they've had, not only in terms of uptake, but also in terms of making the cost benefit sort of work for them in their favor. And yes. I do wonder, is that an issue for you in terms of trying to find investments?
Yes, I would say some of these companies are well positioned to use AI to gain additional share. In the case of Alphabet, it's more as a defensive move on the search side. In the case of Meta, potentially they can use AI to increase their share in search, which is still relatively small. So the potential capital market gain could be quite substantial. So every company is different. You really need to look at it case by case.
Jimmy, we have to leave it there. Always a great conversation with you. Jimmy Chang, he's Chief Investment Officer at Rockefeller Global Family Office. We're counting you down to the closing bells. Just about 2.5 minutes to go, Alex. Actually, a modest bid coming back into markets. We're actually close to the highs of the day, but still fractional gains.
Okay, told you though.
Yeah.
So it's still
I told you though.
3 straight
I mean, your
days.
Glass, when did you become a glass half full kind of person?
Just for this like 1 second, because the superlative is kind of good.
Just to antagonize me?
But
right.
I loved what you were talking about in terms of the AI spend, because it's no surprise that utilities would be the weakest performing sector on the S&P. I understand that there's the yield component there, but usually it's about power and driving that power demand. If that changes, that's an underpinning for that sector.
Yeah, that story has really kind of cooled as of late. I mean, we're talking about that a lot. A lot to parse here on a relatively busy day in U.S. markets. Our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through the closing bell. A global simulcast starts now. Scarlett Fu here in the TV studio. Carol Massar and Tim Stenevik, they're in the radio booth as we welcome our audiences from Bloomberg Television, radio, as well as our partnership with YouTube. Carol Massar, not quite the barn burner of a day that we saw yesterday, but according to Glass Half Full Alex Steele, she'll take it up 0.1% on the S&P.
It is a little bit of, it feels like, investors trying to be bullish in this environment, but I feel like this is more of the trade we've seen as of late. But, we'll see. Consumer sentiment was a bit of a bummer here, and so sentiment can turn into reality, and I think that continues to freak out investors a bit.
Well, if yesterday was all about conviction, today is all about searching for direction. The S&P 500 moving between gains and losses today many, many times. By my count, about 20 times, Scarlett.
Yeah, well, you can't really count on the U.S. market to rise every day the way you could last year. In the meantime, you look at European stocks up 1%. Jimmy Chang was just on, and he was telling us from Rockefeller Family Global Office that we're still, at least for foreign investors, in the early stages of reallocation to other markets like Europe, like Asia.
I will point out that we're still up for 3 straight days for the S&P. This is the glass half full part. We haven't seen that since February. I appreciate the gain is pretty sad. But, can we actually build on that is really the question if we do close a little bit higher.
Yeah, it'll be interesting, too. Basically, about half the stocks in the S&P up, half down, but some big names like Tesla moving higher. Mobileye, one of the big gainers on the day as well. We should point out a modest bid coming back into bonds, which is pushing yields lower. The VIX continues to drift lower as well. And the dollar, we'll just call that unchanged on the day. The Bloomberg Dollar Index down about 0.1%. The Dixie down a little bit less than that. We get the closing bells here in New York. And it looks like it's going to be green across the screen, at least for the 3 major averages here. The Dow Jones Industrial Average is going to finish the day higher. It's only up about 12 points here. We have to wait for it to settle on a percentage basis. Now only up 4 points here. We're just going to call that unchanged on the day. The S&P 500, this is easier to do, up 9 points or about 0.2% on the day. The NASDAQ Composite up 83 points on the day. or about 0.5%. But here's your glass half empty scenario. Dow Transport's down 0.8%. S&P 400 mid-caps down 0.3%. And the Russell 2000 losing 14 points or 0.7%.
All right, I'm going to go back to something, Romaine, that you pointed out, that if you look inside the S&P 500, it's kind of an even split, a little bit more to the downside. You've got 218 names actually gaining ground in the S&P 500. Scarlett, 282 to the downside, 3 unchanged.
Can you name them all?
No. Not now.
Well, let's name 11 of them. How about that? Let's look at the 11 sectors in the S&P 500, and more green than red. Communication services, the best performers, up 1.4%. Some of those broadcasters like Fox leading the advance there. Consumer discretionary also gaining by 1%. And financials in the green as well. Interestingly, utilities are the worst performers, down 1.6%. Over the past year, they and financials are tied for the best performance, up about 21%. Of course, the excitement over the build out of data centers is certainly waning in the early months of 2025.
All right, guys, let's get to some of the individual gainers. CrowdStrike on that list. We saw that an outperformer in both the S&P and the NASDAQ 100. BTIG upgrading the stock to buy from neutral, citing the growth potential of the company, saying with the July IT outage now in the rearview mirror, we think CrowdStrike has much better visibility on forecasts, according to the analyst Gray Powell, who wrote and put out the note. Setting a price target at $431 a share, stock closing at $384 and change, almost $385 to be more specific. So we're looking at a little bit of upside from today. Again, CrowdStrike up about 3.3%. Carvana, an outperformer today at its highs, up almost 6%, finishing the day with about a 3.7% gain. Morgan Stanley raised the company to overweight, saying the pullback in shares creates an attractive entry point. Keep in mind, we had seen the stock down about 25% from a peak in February through the last close amid a broader market slump. They set a price target to $280 from $260, and Carvana closing at $221.66 a share. And then just throwing this one out, Trump Media and Technology finishing up almost 9% in today's session. The company, of course, home to the president's social media site, jumping after signing a non-binding agreement to partner with Crypto.com for a series of ETFs through its Truth.fi brand. Am I saying that right? I don't know. Stock is down more than 30% year to date. 11% of the float shorted.
This is your stock.
Stock is down about 76% from the March 2022 high. All right, I'm passing the baton real quickly.
All right, I'll take the baton, and I'll talk about UPS. Shares down today by just over 5%. They fell the most intraday going back to February. Bank of America analyst Ken Hexter now expects the delivery company's first quarter EPS to fall meaningfully short of the consensus estimates. Those earnings come out next month, April 29th. Mark your calendars. Shares are still down about 45% since those 2022 highs. Once again, UPS down 5% today. Also, taking a look at shares of fertilizer stocks today, they fell as U.S. and Russia restored market exports. CF Industries is the world's largest producer of nitrogen fertilizer. It fell today by 2.3%. It dropped at one point today to the lowest in 8 months. A suspension of hostilities in the Black Sea region, which is a critical trading route for fertilizer, grain, and other farm products, is expected to loosen up supplies from the region and ease volatility. Once again, shares down a little more than 2%. And finally, Lumen Technologies, not to be confused with Lumen from Severance fans. Any Severance fans here?
Yeah. Hey, did you see, Tim? We had a waffle party upstairs.
Did you?
This morning.
I saw that today.
Yeah.
I did. Yeah.
I don't know if that was like tongue in cheek or if they knew what they were doing.
You know, I'm a little behind, so I'm only up to the melon party at this point.
Oh, once you get to the waffle party.
Yeah.
Hey, spoilers.
I have that to look forward to. Shares fell 9.5%, despite the fact that we're watching some M&A news. Bloomberg News reported that AT&T is in talks to acquire Lumen's consumer fiber operations, a transaction value of over $5.5 billion. This is according to people familiar with the matter. Shares spiked higher after that, but then fell at the end of the day by more than 9%.
All right, we are actually getting earnings now. This actually out of GameStop. Net sales in the most recent quarter down $1.283 billion. That's compared to $1.794 billion in the year ago quarter here. Adjusted EBITDA in the quarter, $96.5 million for the fourth quarter. That compares to about $88 million in the prior quarter. There's not really estimates to compare to because no one really covers this company in that type of depth here. But overall, those are your two headline numbers. You're seeing a modest move in the shares. Up about 2%. We'll dive a little bit deeper into the release and see if there's anything meaningful in there about this company's future. But I should point out, as with most of its releases, it is incredibly brief.
Yeah, I was going to say, I kind of skimmed the release. I didn't really find much. Okay, I'm going to the bond market, guys. So buying across the curve, pretty much. You had a 2-year auction that went really well today. There was very strong demand. And then tomorrow, you get the 5-year and then the 7-year on Thursday. So we're going to be watching for that. We're looking at about $70 billion in 5-year notes coming tomorrow. It looks like the takedown's doing pretty well, especially if you have 2-year yields right around 4%. You're clearly going to have some buyers stepping in there, guys.
All right, guys, I don't know how many times your bosses come around and say, hey, what did you do last week? But if you work for the federal government, you certainly get that from Elon Musk, of course, who is running Deaux. And apparently the email and the inbox at the government got a bit clogged up.
It's full. So workers who've been submitting their list, which is part of the Deaux effort to cut the federal budget and downsize the federal workforce, they're getting bounce back emails that are telling them that their message weren't delivered. Here's what they say. The recipient's mailbox is full and can't accept messages now. Please try resending your message later or contact the recipient directly. What are you supposed to do now?
Sounds a little inefficient to me.
Are you supposed to just get in touch with him on X and tell him this
NASA created an app for workers to use to send their reports instead of messaging the Office of Personnel Management, and they called it a secure internal tool. So
is it called Signal?
Too soon.
Too soon.
Way too soon.
I had a feeling that was going to come up. Yeah.
Sorry.
They're still trying to clean that whole situation up and answer the questions that have been raised. What about the other story, which is folks in Canada are loading up buying this mega pack of beer, 1,461 cans of Moosehead beer. It's called the Presidential Pack because it's one for each day of Trump's presidency.
I love this. It's like $2,200 or something to buy it. Of course, the first thing I said was like, where do you store all of that? But I thought it's definitely a marketing gimmick, but people may be buying it.
It's all about buying Canada and not buying American products like American beer.
Yeah. And also to survive through the presidency, I feel like I'm reading between the tea leaves on that one.
For Canadians, yes.
For Canadians.
Yeah, interesting.
I've never had Moosehead beer, by the way.
No, it's so good.
No.
You've had it?
I've never had it.
Someday, sure. Who hasn't?
This cannot be shipped to the U.S., by the way. This can only be shipped to 3 different Canadian provinces.
Which makes sense.
Just 3 different which provinces don't get it. Just real quickly, guys, I do want to go back to GameStop for 1 second. The shares now are starting to take off just a little bit. The company, this will be music to your ears, Tim Stenovic, has now updated its investment policy statement to add Bitcoin as an asset. It says it's going to add Bitcoin as a Treasury reserve asset. Doesn't exactly say by how much or when, but the share is getting a little bit of a pop off of it.
We're doing this again?
Again, apparently.
Okay.
Maybe they'll be like MicroStrategy, turn yourself from a software company to a crypto hedge fund. Or what? Well, who knows? Who cares? But look, GameStop, are you buying games anymore?
No.
I'm not sure what anyone's buying there.
Okay, but you're buying crypto, right?
I'm not buying crypto.
He's totally buying crypto.
No, collectibles.
You're
buying Moosehead, right? Something. You're buying anything?
With crypto. There we go.
I'm buying time.
Can you spend? Help this economy out, Tim?
He can't.
More likely to buy Moosehead beer.
Moosehead beer.
Oh, Morse.
What did you say? Moosehead? like Norse? Like the god? Wow. Okay.
There's a big moose on the crate, Carol.
That is
Carol's
a total
already
wrap.
started drinking again.
I know.
Right.
If it's only Tuesday. Oh, it is only Tuesday. All right, guys, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we do it all. I know Alex is heading out, but of course, Romaine and Scarlett finishing up on TV, and Tim and I continuing without Moosehead beer here on Business Week. We'll see you tomorrow.
All right, a lot to cover here on the big program. And just yesterday, we learned about eToro filing for an IPO. Klarna said to be doing it as well. CoreWeave as well. Does this mean that the IPO market is back? Well, maybe and maybe not. When we come back, a conversation about all those private companies looking for an exit path. A conversation with Derek Liu, partner and co-head of Private Capital and global co-head of healthcare over at EQT. Stick around. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. It's kind of an interesting day once again. We've had this kind of seesaw in markets now for the last few weeks. It's up one day, down the next, flat, then this. And that's kind of what we got today. Markets were flat. They opened flat, and they pretty much closed flat. It is in the green, though, up 0.2% on the S&P 500. And I'll just take Alex Steele's sort of a more optimistic line here. This is actually the third day in a row we've actually seen a gain on the S&P 500. It's a modest gain, but 3 straight days of gains. The first time we've actually seen that on the S&P since early February here. So maybe a tinge of optimism if people really tried to assess and, more importantly, parse trade risk as well as economic risk. You saw some of that risk reflected here in the drop that we saw in utility stocks here on the day. The flip side of that, of course, was we actually saw a big boom in cybersecurity stocks on the back of a relatively bullish forecast and a couple of interesting upgrades, CrowdStrike, Cloudflare, and a couple of others, and that provided a boost there. So there are areas in this market where you can maybe find opportunity. Meanwhile, on your bottom of your screen there, this is a gauge that actually tracks base metals. Earlier in the session, we saw copper futures hit a record high, and that was not necessarily for a good reason, but nevertheless, if you want to play it here, there are a lot of stocks out there that did well in that space.
Yeah, everyone's searching for a catalyst now that earnings season is pretty much over, so sell-side notes provided a lot of that for individual movers. We're going to start with UPS, down 5% on the day, the biggest slide in about 2 months after Bank of America cut the company's first quarter earnings per share forecast to below consensus, citing volume pullbacks due to tariff uncertainty as well as winter weather. And we saw gains in some hospital companies. Universal Health up 2.4%, Tenet Healthcare gaining about a 1%. Deutsche Bank suggests buying these names because they've fallen about 80% as a group since their highs in September. They're basically left as dead money, according to Deutsche Bank. And as soon as we get some budget policy clarity and the threats to cut Medicare spending and Medicaid spending pass through, the stocks, according to Deutsche Bank, are ripe for a relief rally. Now, that brings us to our top story this hour, which is the costs of policy uncertainty. Unanswerable questions over tariffs and budget negotiations are leaving markets in flux and consumer confidence at a 4-year low. With U.S. stocks stalling out, investors are moving on to greener pastures like defense companies in Europe, for instance, while companies themselves are left paralyzed, unwilling to move forward with big investment plans. Later on this hour, we're going to speak with the CEO of Build-A-Bear to get her take. Romaine?
Yeah, absolutely. Here, remember, coming into this year, this was kind of supposed to be the year where we were really going to see capital markets open up, whether it's M&A activity or the IPO market, an IPO market that, quite frankly, has been on ice for a few years. While 2025 did actually start stronger, or at least stronger than the past 3 years. In fact, you had about $12 billion of first-time share sales announced just in the first 3 months. That's well short of expectations and a fraction of the pre-pandemic norms, as economic uncertainty and that market volatility actually creates more incentives for private companies, well, to stay private. Our next guest, weighing in on the exit environment, says, given today's tough IPO landscape, we're actually seeing creative partial exit strategies emerge, like continuation vehicles and, quote, private IPOs that offer liquidity while keeping the companies where they are. Eric Liu joins us right now. He's partner, co-head of private capital, and global co-head of healthcare over at EQT. Great to see you, Eric.
Hey, thank you.
What is the path right now for private companies? I mean, there's so many private companies out there that with high valuations, I should point out, relatively mature companies here. Do they need to go public?
Yeah, so for us, if you think about the typical life cycle of an investment that a private equity firm might make, we'll tend to hold the companies for 4 or 5 years on average, and then at some point we have to exit to get capital back to our LPs. Mm-hmm. We can sell to another private equity firm, we can sell to a strategic, or we can take a company public. The IPO markets, people say, are they open, are they closed? The reality is that for the highest quality companies and the best markets or the best management teams, you have been able to take those companies public the last few years. Mm-hmm. We had a company, Kodiak, Galderma, Waystar. We've had 3 IPOs. We've had to take fairly significant discounts at the IPO in order to get the company public. Mm-hmm. But for us, IPO events are financing events. Mm-hmm. They're not exits. And so if the company can hit quarters over time, that's when you can see the stock price start to rise and achieve its full valuation. That's
a great distinction, and I'm glad you pointed that out. I am curious. I mean, you talked about this idea of taking the discount. I remember having conversations with people like you a year and a half ago here, and they said there was a little trouble in trying to convince the founders to actually understand that they were just going to have to take that discount one way or the other. Have you actually seen people more receptive, I guess, for lack of a better word, to that reality?
So it depends who you have to convince.
Okay.
If it's a venture capital-backed company, it's a founder. If it's a private equity firm, it's typically your other partners on the investment committee. Yeah. But I think for us, what we found is that because we view IPOs as financing events, as long as we're not selling and we have a high confidence the company will deliver over time, as the company's stock price rises, those are the valuations that we care about.
How would you compare the current market for IPOs to previous lulls in the market that we've seen? I mean, I'm guessing it's not as bad as 2022 when it felt like inflation spiked and the Fed was hiking rates aggressively and the entire IPO market just simply collapsed.
I think the IPO market is just very selective, as I mentioned. But back in 2020 and 2021, it wasn't that selective. So these things tend to move in cycles. I think a lot of investors, they want to take their time. They don't want to be the public market investors. It has to be really high quality, otherwise they won't buy. And then sometimes, even when the company goes public, they're going to wait. They actually want to see the stock price move up. They'd rather buy the company after the price is higher, which is a bit paradoxical.
And of course, Romain mentioned...
They want to know it's safe or have some sense that it's safe.
They want to see a track record, basically, right? Romain had mentioned this partial exit strategies, how that's coming along. What does that look like? I take it they start kind of as a workaround, but are these going to start becoming the norm more often than not? Yeah, so the private equity industry is quite creative. I would say the financial markets in the U.S. in general are quite creative. So people find ways of getting liquidity. So what you sometimes will see is people will sell 40% of a company they own. They'll sell 20%. Or sometimes we have a company in Nord Anglia in Asia where they brought a broad base, I think, of 75 new institutional investors into the company. It's still private. We're still managing it. So it's a private company that has actually a quite broad investor base where those new investors get to benefit from our private equity value creation strategy in the private setting.
How do you feel about the regulatory environment, or at least the promise of changes to the regulatory environment, at least here in the United States? Is that going to be more conducive to deals?
Well, it depends on what changes you're talking about. But I would say, I think going into this year, people thought, oh, new president, there's going to be less antitrust focus on certain companies. The reality is a lot of that focus is going to remain, and people thought there was going to be a lot of activity in the first quarter. But M&A deals do take a while. I mean, even private equity firms, which move fairly quickly in doing diligence, it could take months. And so if people started something at the end of last year, it's not necessarily the case you'd start seeing those announcements today. I think you'll continue to see improved volumes going forward.
Do you see more opportunity, or do you see favorable opportunity right now for new investments?
Well, I think for us, we have 140 people globally in our private equity practice. We have people always looking for new investments, recruiting new advisors. So we always have an attractive pipeline.
Is that job harder now?
It's always been hard. I've been doing this job for, I think, since 1998. And every single year, it's so hard now, it was easier 5 years ago. But yet, if you look back, in every single year, people have found good opportunities and made money for their investors. And I expect that to be the case in this environment as well.
So we're talking earlier about how our theme for this hour is really uncertainty. Uncertainty tied to government policy, whether it's regulatory, whether it's trade, whether it's fiscal. EQT as a firm has chosen to avoid certain kinds of companies. As global co-head of healthcare, you don't look to invest in healthcare providers because there's a lot of regulatory pressures present in that sector. How much policy risk does the new head of the HHS pose, even as someone who looks at things in a 5-year period over the longer term?
Yeah, so if you think about what we do, so within healthcare, we have a very focused strategy. I'll just pick healthcare to start. We invest in medical devices, life science tools, pharmaceutical services, and healthcare software companies. In each of these instances, we're not taking direct government reimbursement. We're not treating patients directly. So these are businesses selling products and services to other businesses who are making arm's length decisions on this, I think, is superior. So I think in that particular environment, your regulatory risk is a bit lower. I mean, healthcare is still a regulated environment, but you're not as directly exposed to it as you would be if you're buying a hospital chain, for example.
Right. Those hospital stocks that Deutsche Bank was recommending people take a second look at. All right, Eric, thank you so much for joining us today. Eric Liu is co-head of private capital and global co-head of healthcare over at EQT. Coming up, we're taking a look at copper prices hitting a record high. We're going to break down the move with Bloomberg's Joe Deaux next. This is The Close on Bloomberg. All right, we saw U.S. copper futures hitting a record high on the back of tariff bets and reports of halted shipments from a top producer in Chile. Now, joining us to discuss more is Bloomberg's Joe Deaux, who covers machinery, metals, and mining. So tariffs feels like it's the ever-present threat when it comes to any product these days. But let's talk about the halted shipments from Chile. What's going on there?
Sure. I mean, when you're looking at Chile, there's a lot going on. We've got questions by the Chileans of what exactly do these copper tariffs mean for them? Are they going to get some sort of exemption? I think these are all the questions on the table. I think, though, the actual move in the markets just continue to be dictated by how we are actually seeing the tariff question play out. We've got a lot of questions over smelters here and there, and sure, the fundamentals still are at play. But when you're looking at record highs in the copper price traded in New York, versus what you're seeing in the LME, right? And I mean, the LME is the true global benchmark.
Yeah.
But we're looking at copper prices in the U.S. already being on New York traded $1,400 higher than the LME. This is purely a trader play, and that is everybody trying to get the metal into the U.S. right now.
But do you find legitimacy to that? Or meaning, are we actually seeing the flows yet? Because I've heard this theory already that somehow we end up being the beneficiary because we are effectively the largest market, or at least the more lucrative market for a lot of these producers.
Right. Yeah. I mean, we're already starting to see the numbers climb into the United States. The big banks, I mean, Goldman and Citi and some of the big traders, Trafigura and Mercuria, have also come out in recent days kind of pointing out that you're seeing the flow come into the United States of America from all over the place. You're seeing numbers thrown out there of, $12,000 copper, right? Everybody knows it's real and the trade is on.
Yeah.
I think that's really the big thing at play here, and the flows are starting to show through on it.
And $12,000, just to be clear, I mean, right now we're in the 5,000 range.
Yeah, I mean, these are like insane numbers.
I mean, those are insane. I mean, $12,000 copper would effectively crash our economy because no one could actually afford it.
Yeah, I don't know if that would be true. Maybe I don't know if that would be true. But I think when you start to talk about like $12,000 numbers, it's like think to the nickel issue that we had a few years ago when it went to over $50,000, right? It's just like numbers that aren't
real.
They're not things that we talk about on a daily basis. Like, if you're to sit down with a copper trader tomorrow, they might just say like, yeah, these are kind of things that we haven't seen before.
Right.
But yeah, I continue to point out, it's just wild to see New York copper at a price that is so far above the London Metal Exchange.
Yeah.
And that's all the talk, and everybody is listening to every update that President Trump gives, and they're just trying to figure out, like, what's next? What happens here?
All right. So we're certainly locked in on that. Joe Deaux, who covers the space for us here at Bloomberg. A closer look at copper futures settling today at a record high.
All right, let's get to our top three, where we name drop the people driving some of the day's most talked about stories. And first up is Ray Dalio, the Bridgewater founder, warning House Republicans of dire debt, urging them to cut the budget deficit to just 3% of GDP. Remember, it was at about 6.6% of GDP in 2024. So that would be a huge reduction.
Yeah, Dalio's been making the rounds here. Of course, he's on Indonesia, he's on Capitol Hill, he's doing a lot of things as well. Also, though, out on Capitol Hill was the president of Dartmouth. I've been keeping an eye on her, and she's got some concerns here. Of course, there's been a lot of saber rattling out of the White House, but also Congress. They're actually looking to potentially raise the taxes that these endowments pay. I think right now they're saying that on average it's less than 2%. There's some proposals to actually raise that tax to as high as 21%.
Yeah, and of course, this is a way for them to raise revenue because they plan to move forward with the big tax cut, or at least keeping the tax cuts intact. Dartmouth, by the way, has a endowment that's worth $8.5 billion right now. All right, in terms of the third person that we're watching, Alibaba Joe Tsai, he's a chairman, is warning of a potential bubble forming in AI data center construction due to a lot of those projects being built without clear customers in mind. He says the pace of the build out may outstrip initial demand for AI services. Surprise, surprise, the optimism went too far in one direction.
Yeah, and you saw that reflect a little bit earlier here in Chinese stocks here. You had a big drop down over there, down about 2.5%. But it's kind of the same issue you're going on right here, right? As soon as DeepSeek came out, there was this whole rethink of whether the USAI spend was there. Now, maybe you're getting that here, at least if you believe what Joe Tsai had to say on that side of the world as well. All right, coming up here, we're going to focus on economic conditions and falling consumer confidence, hitting a 4-year low. A read on the consumer with the CEO and president of Build-A-Bear.
All right, U.S. consumer confidence falling to the lowest in 4 years as higher prices and tariffs continue to pressure the U.S. consumer. Joining us now to discuss is Stuart Paul of Bloomberg Economics. And Stuart, this is another example of how soft data is coming in pretty soft, and it backs up what we heard from the University of Michigan with their consumer confidence surveys as well. The hard data so far seems to be holding up well. Can soft data remain, soft while the hard data shows resilience?
It can for quite some time. It could take up to 6 months at least for some of the sentiment that we're seeing in some of these survey data and in some of these confidence prints to start turning into softer hard data. We'll see it in spending, we'll see it in inflation, we'll see it in unemployment. Right now, what's interesting is that some of the sentiment indices are picking up that consumers are pulling forward their spending plans, which is going to contribute to some chunky hard data, some accelerated spending data in the near term. And then we'll see the soft data start rippling through into the hard data only further down the line once consumers have satisfied their need for new refrigerators, furnishings, other things that they might be importing.
Well, that's what I'm curious about, too. I mean, we get the PCE data on Friday, the monthly numbers here, which shows income, spending, as well as if the effect of inflation. The increase that we're expected to see on the spending side versus the drop that we saw, and I know the last month's drop might have been skewed by seasonality factors, but should we be concerned about how much of a surge, at least if you believe what economists expect on that number? Is that a harbinger of something, or is that just a one-off?
I think that there are really three things to keep in mind going into the Friday report. The first is that core PCE inflation is going to come in hot, about 0.35% month on month. So don't get fooled and become complacent by the low CPI reading. All the components that really matter for the Fed are going to be showing up hot in the core inflation print. When it comes to spending, as you mentioned, seasonality was really in play in January. The polar vortex really weighed on auto sales.
Right.
It's terrible walking an auto lot in the middle of a polar vortex. We're going to see a rebound in that spending in the PCE spending on the Friday personal income and outlays release. And so what does this really mean for the Fed? So we saw today the major uptick in inflation expectations. We saw an increase in consumer spending plans on things like durables, and we're actually seeing some additional spending when consumers get a chance to actually get outside and do some spending. And we also know that producers, whether retailers or importers, are going to try to pass along the cost of higher import prices and higher input to production prices to consumers. With accelerating spending plans, it sounds like they're going to actually have the opportunity to do it, creating some upward price pressure for the consumer in the months ahead.
Yeah, but it's going to eventually, of course, we're going to feel the effects, like you said, eventually months down the road, and that'll be a cold reality. Let's talk about housing for a moment here, because we were just reporting yesterday, KB Home, a starter home builder, cutting its full-year revenue forecast when it reported results. Affordability remains the big issue here. What have we learned from the new home sales report that we got today, and what are we likely to hear from pending home sales and the other data points this week?
What's most interesting to me, really, in the new home sales report is the inventory glut. Inventories are basically at levels that we haven't seen since early 2008. They're exceptionally high, and the share of inventories that are completed homes is continuing to rise. I think that that's a really important factor here, that you have home builders like KB Homes sitting on this inventory of completed homes. And with mortgage rates staying relatively elevated, even though they did come off in February and March, they're still elevated for millennials and Gen Z buyers who are entering the market. It's going to require a little bit of price cuts, a little bit of wiggle room from builders if they're going to get this glut of inventories filled with prospective buyers.
All right, Stuart Paul over at Bloomberg Economics, a busy week for economic data, including that PCE report, where we get a much closer read here on Friday as to how much people are making, how much they're spending, and what their inflation expectations are. All factors that have had a huge impact on what we've seen, maybe not in the hard data, but certainly in that survey data. For a unique read on, well, how the consumer is feeling, let's take a trip to a Build-A-Bear workshop. It's a multi-million-dollar company and has over 500 stores across the globe, and plans to expand the brand's reach despite some of the economic certainty and lingering tariff threats. Sharon Price-John is the president and CEO of Build-A-Bear, and she joins us here around the desk in Studio 2. Great to see you.
Oh, you too.
Are people stocking up on Build-A-Bears now because they're worried about tariffs?
Are they stocking up? Well, I don't know if they're stocking up, but I can tell you, as we noted in our earnings call just recently, that our quarter-to-date sales were quite strong. We were very pleased with them, and we had another record-breaking year. That was our fourth consecutive year of record-breaking results. So with an expectation of a fifth consecutive year that we announced with our guidance. Now, Build-A-Bear could be a little bit different in that about a third of our sales come from birthdays. Birthdays happen all year long, and you certainly don't want to deny your child an opportunity to celebrate the birthday that they want to sell. But we've been through a very specific effort over the last few years to diversify not only our consumer base. So we've expanded our addressable market to adults, 40% of our sales, as well as diversify our supply chain. So we were at one time, the majority of our products came from China, and now it's less than a majority. To diversify where we are as well. So we're very global at this point.
Given your global footprint, whether it's sourcing materials or whether it's actually your customer base, which is now global, I am curious as to whether you feel exposed to some of the policy changes out of Washington with regards to trade and tariffs.
We always have to look at what is going on from a global perspective and what's going on from a tariff perspective. Any sort of thing like that is important for us. And the situation is that I think under most circumstances, we have some clarity around what's happening. And so when we provided our guidance, for example, you have to provide the guidance with the information that you have in the moment. Now, I understand with some of the discussions around what's coming up on April 2nd that there could be a little more flexibility, I think is the term that was being used. And of course, we would welcome that, not just from Build-A-Bear's perspective, but from the entire toy industry perspective, because we certainly see toys as essential for children's health and well-being.
So Romaine joked by asking whether people were loading up and hoarding bears before the incoming tariffs. But from your point of view, at some point you need to increase inventory as well. And this came up during your earnings conference call too. Can you talk a little bit about the buildup of inventory because of the incoming tariffs?
Right. We actually mentioned that in our third quarter call that we had increased our inventory position and expected to do that because we really didn't know what was going to happen. And that was one of the reasons why we saw a little bit of softness in our cash. But I think that we were not alone in those choices. So we will do the best that we can do. Now, remember, we're also a vertical company, so we're a vertical retailer. So we do have a little more pricing flexibility with what we do as well. And we have great relationships with a lot of our factories. So we'll do the best we can.
As much uncertainty as there is in the U.S., there's probably some more visibility in your other markets. What are your fastest growing markets, and where do you have the most conviction, the most visibility across the globe?
Well, the tariff situation is different in each market.
Sure.
Like there aren't, if it's being imported from China or Vietnam or wherever it's being, a lot of the countries that we're in are not changing their tariff approach. So that is actually a good thing in terms of that helping us to being diversified and help us balance the amount of tariffs on the total that we absorb. So.
It's funny. Earlier, you talked about kind of toys being essential, and you talked about birthdays, things that obviously parents aren't going to deprive their children, assuming they can afford it. One thing with Build-A-Bear, though, too, it is kind of an experience, right? You're not just really just
it's not
necessarily
kind of an experience.
It's an experience, right? But it's not just going onto a shelf at the local toy store and just getting something. Half of the pleasure is taking your child to the store and having them being able to see the bear getting stuffed and picking out all the accoutrements and things like that here. Does that provide a little bit more resiliency if we do get an economic downturn? Because we talk about this as if somehow people stop spending altogether. They still spend, they're just more selective about it. And I do wonder whether you see that as an advantage.
Now, that's a really interesting question. And we've been around for over 25 years now. So if there is an economic downturn or any type of recession, this will not be the first recession that Build-A-Bear has lived through. But I think that, yes, having an experience, having something that is unique is certainly helpful, but also recall that we've gone through a lot of changes to become much more of an omni-channel company. So we also have a very robust business online. But that being said, over the course of time and having been in the toy industry now for almost 30 years, while really no sector is recession-proof, there is some recession resiliency simply because of some of those comments that you've made about you try not to deprive your kids of and it's not just about fun, it's also about learning and experience. And I think that is one of the reasons why we take the position of the importance of toys for kids.
How comfortable are you right now with your staffing levels?
Our staffing levels? You mean at the store level?
Yes.
Very comfortable, yes.
No need to hire more people, no need to get rid of anyone?
Well, we're quite flexible with our staffing, yes.
Okay.
We talked about experiences and going in and building the bear yourself. All of that requires some freshness and some anticipation and excitement, and a lot of that comes through partnerships.
Yes.
You've announced a number of partnerships in the past. What are the ones that have really gained traction?
Yes, so we have a lot of different types of licenses. We enjoy some of the best-in-class licenses associated with long-term relationships as well as new movies. But one of the best ones that came out last year, we launched a new store in conjunction with Hello Kitty. And that's in Los Angeles, yes. And so that's quickly risen to be one of our top stores. And we've had a long-term relationship with Hello Kitty and the Sanrio people, but that's been a really amazing experience for us with lines around the block.
Is that limited edition or is that permanent?
Permanent's a long time, but it is a held lease, yes.
All right, fantastic. Sharon Price-John, thank you so much for joining us today.
Thank you, I really appreciate it.
Sharon is the president and CEO of Build-A-Bear. And of course, Romaine, it's an open question here for a lot of these consumer-facing companies. Not only do they face a lot of uncertainty from consumers themselves, but big question marks as to what's going to happen on the policy front.
Yeah, on the policy front, and I mean, I think we've talked with so many CEOs, and we know the challenges there. And we talk about the other end of that, which of course is the consumer. At some point, there has to be a balance. I mean, you hope there's a balance. It'll be interesting to see how it all shakes out.
All right, let's take a look at how markets closed on the day. It was kind of a want day when it comes to the indexes. Slightly higher, better than basically little change for most of the session. Up 0.1%, almost 0.2%. But you were mentioning third straight day of gains.
Yeah, third straight day of gains. The first time that's happened actually since early February. I don't know how much stock you put into that, given how topsy-turvy they were. When you go back to Friday, you were up 0.1%. Yesterday, you're up almost 2%. Today, you're only up 0.1%. But like I said, if you're a glass half full kind of person, you'll say, you know what, rah-rah.
Yeah, utilities, the worst performers. They've been the safe haven for a while, but also a growth sector in that they were tied to increased use of energy to power those AI data centers that everyone was so gaga over.
Yeah, and a bit coming back, of course, into some of those big tech stocks, and of course, keep an eye on everything going on in the commodity space here. You're looking there, copper futures there at a record high, and other base metals also rallying hard on the day on the back of those tariff concerns. When we come back after the break, it's all about the Benjamins. We're going to take a look back in history at a major facelift for the $100 bill. This is The Close on Bloomberg. All right, let's take a look back at this day in history. In 1996, when the United States government began the most sweeping overhaul of its currency design since the 1920s. The redesign, it was a culmination of a 5-year effort to curb a rise in counterfeiting. There have been efforts in the past now to combat counterfeiting and, quite frankly, just to make the U.S. currency system more secure. For example, in 1946, the government ceased to print bills larger than $100 and officially pulled them from circulation by 1969 because of concern that those bigger bills, $500, $1,000, $5,000, and even a $10,000 bill, they had no real utility for regular Americans, but great utility for money launderers and criminals. By the 1980s, another problem popped up, though. The proliferation of color copiers and other high-tech machines, which made it incredibly easy to make passable copies of U.S. currency. So the U.S. chose to roll out a series of security features on its bills, and it started with the highest denomination, the 100, unveiling on this day in history a redesign dominated by a larger portrait of Benjamin Franklin, ink that changed from green to black when viewed at different angles, and a security thread that glowed red when exposed to ultraviolet light. It was a long time coming. The $100 bill, first issued back in 1862 by the Treasury. But other than that, than a change in the size of the bill in 1929 and a few minor tweaks in the 60s, the C-note had largely been unchanged for decades. Now, eventually, the 6 other U.S. paper denominations went through a similar makeover. As for the $100 bill, it remains the highest denomination of U.S. paper money and the most popular. In terms of volume, there are more $100 bills floating around than any other denomination, accounting for about 35% of all U.S. paper in circulation.
And I would bet a big chunk of that is overseas as well. Okay, let's transition from cash to meme stocks. GameStop reported earnings this hour, saying sales dropped 28% versus last year, but you're looking at the stock jumping in after-hours trade, up almost 6% after the board updated its investment policy to add Bitcoin as a Treasury reserve asset. In a move similar to the days of the meme stock craze, a handful of European stocks are rising as investors anticipate a surge in military spending across the continent. For more on this, let's go now to Bloomberg News editor Nathaniel Popper. Nathaniel is the author of The Trolls of Wall Street, How the Outcasts and Insurgents Are Hacking the Markets. Nathaniel, good to speak with you. I'm curious, when you look at the rally that we're seeing in European defense stocks, names like Hensoldt and Rent Group and Eutelsat, do you see parallels between the meme stock craze in early 2021 and what we're seeing in Europe now?
Absolutely. It's really interesting how the meme stock phenomenon has gone global. We've seen this already in India and South Korea, and now we're seeing it spread to Europe, where retail traders are taking on some of these heavily shorted names, a lot of them defense sector stocks, and getting this sort of Reddit bump that we've seen with American stocks in the past.
Yeah, the Reddit bump where everyone kind of gathers on these chat boards and talk about how they're going to kind of stick it to the man, that the big hedge funds or the big investors behind some of the companies that are shorting them. Talk to us a little bit here about the narrative driving European defense stocks, though. It's rooted in something fundamental, the idea that European countries like Germany and France will need to increase their spending on military needs. Whereas I'm not sure that there was a narrative really supporting GameStop in early 2021.
Yeah, the similarities are interesting, and so are the contrasts. On the similarities, these are in both cases in the U.S. and Europe sort of populist movements. The little guys taking on the big guys. But in the United States, meme stocks have tended to be associated with the Trump crowd. A lot of the meme stock traders in the United States love Elon Musk and Tesla. And what we're seeing in Europe is the populist appeal of meme stocks is actually taking on Trump. So these are European companies that have benefited from the sort of rearmament of Europe as America steps away from Ukraine, steps away from the defense of Europe. You see these European defense stocks that are benefiting, and meme stock traders in Europe are coming at this with a sort of nationalist populist bent and say, we've got to come to the aid of these European companies that in many cases American hedge funds have been shorting. And so there's this sort of interesting nationalist dynamic, both in the US meme stock movement and in Europe.
But going back to your book though, it was a fascinating read on just kind of human psychology, if you will, or trader psychology. If they are indeed buying these stocks up out of national pride, and there is a real fundamental case for doing so, then does that mean that there is maybe potentially a longer life to this trade than maybe what we saw here in the U.S.?
That's a great point. I think in the United States, it really was all about the memes, particularly when it came to GameStop, to some degree when it came to Tesla. In Europe, you're right. There's been this real shift in the way European countries are approaching defense spending. And so I think there is the possibility for some of these heavily shorted stocks to really benefit in the long term from more, German defense spending. A lot of these are companies, the French company Eutelsat is the satellite company that's going to do better if European companies move away from Elon Musk's Starlink.
Yeah, I am curious. I'm going to kind of bring this back to the U.S. We only have time, I think, for one more question. I am curious as to kind of what happened to a lot of the U.S.-based meme stock traders, if you will. There's been a lot of theories that a lot of that was fueled by the fact that we were in a pandemic, so people were at home and they had nothing else to do. And also just this idea, as you pointed out, the political dynamics in the U.S. are a lot different, certainly, than what we're seeing overseas. Are those people just gone, or are they just kind of morphed into something else?
No, everyone thought they were going to go away after the pandemic. This has been an incredibly sort of durable trend where retail investors have stayed in the markets, and we continue to see them evolving, but putting their money to work. And we've most recently seen this in the recent sort of turmoil in the markets. Retail traders have once again been stepping in and buying stocks when everybody else has been selling. So this is not something that has come to an end.
Yeah, absolutely. We were just talking about that earlier today. When you look at the inflows into this market over the past few weeks, a lot of outflows on the institutional side, but on the retail side, the money's still pouring in. Nathaniel, a great conversation. Nathaniel Popper is the author of the trolls of Wall Street. A great read into, I thought, not just about the meme stock craze, but really just trader psychology. I'm like a nut for that kind of stuff.
Yeah, no.
Kind
human
of understand
behavior.
why. Human behavior, absolutely.
Speaking of human behavior, now that GameStop is going to be buying Bitcoin, does it turn into MicroStrategy turn strategy, which is a proxy for Bitcoin in every way?
Yeah, I hope not.
Well, I mean, that's the question. As long as its fundamentals are declining. I mean, hardware and accessories net sales down 34%, software net sales down 38%, collectibles rose 16%. So there's that.
If you're gonna laud anybody for this, I know Michael Saylor, everyone thinks he's a nut, but he started down this road very early. I don't know if you want to come in at 88 grand and try to replicate what he did. Maybe you can do it. Maybe I'll be
It worked for him.
wrong. I will come back. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg. All right, here's what the markets are going to have their eyes on over the next 24 hours. A slew of earnings in the consumer space.
Yeah, Dollar Tree will be reporting of obviously low-income customers, their big customer base, and Chewy and Petco, so a glimpse at the pet economy.
Yeah, and also you get Miller-Knoll, more of the high-end scale furniture there. Here, over in the UK, a couple of economic data points.
I was just looking. Their services rose 4.9%, services prices.
We're also going to hear from the Chancellor of the Exchequer, Rachel Reeves, and then back here in the United States, we get U.S. durable goods. And are you looking out for the CBO estimate of the debt ceiling?
Yeah, they're going to give an update. And the last update we did here was sometime between mid-July and October.
And interesting stuff. We're going to have full coverage of that right here on Bloomberg. Please tune in tomorrow, right here on Bloomberg.